What's up, guys? Welcome to another investing video, and this is a follow-up video to an earlier video that I did explaining how to read some of the general information about a stock or a share. There are some terms in that video that are a little bit more complicated that really do require some time to explain them because they are quite core concepts, I think. So that's what this video is about. So the first one that I'm going to talk about is called the dividend yield. And in order to explain this, first we actually have to understand what a dividend is. Now, hopefully if you've been watching my previous videos, you will understand why the share market exists and how it actually functions. And the key part of that is that when you buy a share, you actually own a part of the company. Now, because you own a part of the company, you are actually entitled to the profits of that company. And the company will pay these out in what's called a dividend. Now, it is important to note that a company is not obligated to pay a dividend. They don't have to pay a dividend, even if they make a profit, okay? And the reason is because the company might feel that that money can be used to go back into the company and invest in the company to improve it. And so, essentially, it is the question of dividend versus capital growth. Okay, so when you invest in a company, you obviously want the share price to go up, because if the share price goes up, then you can sell it at a profit. And this is what we call capital growth. Now, some people don't particularly want that. I mean, obviously it's good, but some people would actually prefer a dividend. Because, for example, older people or retired people, they live off those dividends, right? They might have a share portfolio, a very large share portfolio. They might own a lot of shares, and they want to get that dividend. So typically, and it varies around the world, but in Australia, companies will usually pay dividends twice a year. So twice a year, they will pay dividends, and anyone who owns shares in the company, they will get that money. Now, this is called or known as the DPS, which is the dividend per share. So you might get, for argument's sake, 50 cents per share. So for every share you own, you will get 50 cents, as an example. Right? And the company, it's up to their discretion. The board of directors, it's up to their discretion how much of the profits they want to pay in dividends. And so, as an example, in Australia, one company that's known for higher dividends is Telstra. So Telstra is a large telecommunications company in Australia. It's a very mature company, right? It's not really growing. I mean, the population of Australia is growing, at least it was pre-pandemic. But, you know, they're not a company that's going to grow their earnings by 20-30% every year. So it's a fairly large, mature, stable company. So it's quite hard for them to generate capital growth. So what they will actually do is they will focus on the dividend, because Telstra being a large company, a lot of superannuation funds own Telstra shares. So they actually pay a fairly high dividend. And whenever Telstra has decided to drop the price or lower the amount of the dividend, the price of the shares have been very hard hit, because people buy Telstra shares to get that dividend, right? There's very few people who would buy Telstra thinking that the shares are going to go up in value, and you can actually look up very easily and see the price of Telstra, and over the years it's gone down and down and down, In fact, I think it's halved in the last 10 years or so. So, it's not a very good investment company. This video is not for investment advice, but even if the company was actually, even if they were actually just stable, that might actually be a good investment because you're still earning your 50 cents every 6 months, or usually as well, the dividend is different. The dividend amounts are actually different even in the same year. Now, another company actually outside of Australia, Apple, they are known to focus on capital growth. So for many, many years, Apple did not pay a dividend because they felt that they could put that money back into the company and grow the company. And if you actually have a look at Apple's share price, it's just gone up and up and up. And it obviously has peaks and troughs, but Apple actually became the first $1 trillion company in the history of humankind. So they have very high capital growth, and therefore they have a lower dividend, whereas companies like Telstra will have low capital growth and they will have a high dividend. Okay, so that's important to understand. Now, in terms of the dividend yield itself, so the dividend yield actually tells you how much money you're getting in return for your investment. So if you put your money in the bank, you will know that the bank pays you an interest rate. So they might pay you, for argument's sake, 1%. So if you put $100, if you put $100 in the bank, then you would get $1 in interest for the year. Now, for a dividend yield, if you think it, let's just say, for argument's sake, the dividend yield is 5%, right? So if you bought, let's just use the example before. So let's say that a company's stock is trading at $10. Okay, so that's the market price of the stock. Now, if they pay 50 cents in a dividend, and that's for the whole year. So for argument's sake, they pay 20 cents in one dividend and then 30 cents in another dividend in the same year. So that's 50 cents a year, dividend per share. Then the dividend yield would be 50 cents over $10, which would, there's a decimal place there. So that would actually give you a dividend yield of 5%. So you can do it on the calculator if you want. You'd get 0.05, which is 5%. So what that actually tells you is that if you bought, assuming everything stays the same, so that is critical because the stock price is always changing and the dividend is historical, right? It's the previous 12 months. But what this is saying is, well, if you buy this company at $10 and for argument's sake it stays at $10, and assuming that the dividend stays the same, then you will earn 50 cents in the next year, which is actually 5% of your capital. And so that allows you to compare that to, for example, how much money you're earning in the bank. Because if you're earning 1% in the bank, then that's not as good as 5%, right? So you can kind of think of it as an interest rate. It's not quite, because this 1% is basically fixed. I mean, the bank can change it. Whereas this 5%, it will change every day. It will change depending on the price of the stock. And as I said, the dividend can change. Hopefully, in a perfect world, the stock actually goes up in value and therefore, and the profits are going up, well, the profits are going up, therefore the stock price is going up, therefore the dividend will go up. So over time, you'll see this go up and you'll also see this go up. But generally, it will stay within proportion because it's kind of a management decision. So that's what the dividend yield tells you. So in very simple terms, the higher the dividend yield, the better. It's not always necessarily the case because it might mean that it's not a capital growth stock. So the actual share price might not go up much. But you can use this to compare to other shares. So you might be thinking, well, do I want to buy company A or do I want to be buying company B? So one way you can decide that is, well, what is the dividend yield? And you can also use that to compare to investments outside the share market and think of that risk-return trade-off. Hopefully that makes sense. Feel free to leave a comment below and stick around for the next video.